When was the last time you filled up your gas tank and thought, yeah, that felt normal? This chart shows exactly why. In April 2026, wholesale inflation, the costs businesses pay before passing them on to you, jumped to 6% on an annual basis. Wall Street expected 4.9%. Instead, we hit the highest peak since December 2022. We've spent the last few years operating on the assumption that the worst of the post-pandemic inflation wave was behind us. The numbers tell a different story. The pressure you feel on your budget right now is the beginning of a fresh wave of inflation moving through the economy. To see where consumer costs are heading, we look at the Producer Price Index. Think of it as the price of prices, a tracker for what businesses pay to make and move their goods. When wholesale costs rise at the factory level, companies pass the pain down the pipeline. Costs accumulate at every stage until they reach you. April saw a 1.4% monthly jump, nearly 3 times expectations, meaning these markups will hit retail shelves soon. The math is entirely straightforward here. When the wholesale pipeline pressurizes, your personal budget gets squeezed. 3 distinct forces are driving this surge. The first is energy. This breakdown isolates the monthly PPI increase by category. Notice the gasoline slice. Final demand energy prices spiked 7.8%, but wholesale gasoline specifically surged 15.6%. That single category drove over 40% of the entire monthly increase. That spike traces straight back to the Iran war. US and Israeli strikes have pushed Iran to threaten a critical choke point, the Strait of Hormuz. Roughly 1/5 of the world's global energy flows through that single waterway. Oil markets panicked, sending gas prices at the pump well past $4 a gallon. Expensive oil infects the rest of the supply chain. Jet fuel, diesel, and industrial chemicals all moved sharply higher. Geopolitical energy shocks force immediate cost increases into every sector of the domestic economy. The second force is services inflation. If you strip out food and energy from the data, prices still jumped 1.2% in April. We are seeing higher margins for machinery wholesaling, truck freight costs, legal services, and retail. This is a broad-based structural trend, completely independent of the oil shock. Number 3, tariffs. We are now a full year into the rollout of President Trump's new policies. Tariffs have a direct pass-through mechanic. Importers pay the fee when these containers arrive at the border. They then mark up the price at every subsequent step of the supply chain to recover that cost. Economists see direct evidence that a year's worth of tariffs are now actively materializing at wholesale levels. An oil shock can fade, but sticky domestic services and structural tariff markups mean this inflation is embedded deeply into the economy. All of this wholesale data ultimately lands on the desk of the Federal Reserve. The Fed is holding its benchmark interest rate absolutely frozen at current levels. This visualization shows how Wall Street reacted to the new PPI data. Markets are now pricing in 0 chance of a rate cut for the remainder of 2026. 0. Meanwhile, the odds of a rate hike actually climbed to roughly 39. At the same time, your savings yield stays flat in real terms, because inflation erodes your purchasing power faster than the bank pays you interest. This line graph reveals the final devastating metric. As the inflation line pushes up to 6%, the line tracking real average hourly earnings falls by 0.3% year over year. The average American paycheck is literally buying less than it did 12 months ago. Moving forward, keep your eyes on 3 data points: the Strait of Hormuz conflict, the Fed's upcoming June meeting, and the May PPI report. Until energy costs, tariff pass-throughs, or sticky services break, wages will keep losing the race against the inflation pipeline. To keep track of these shifts in the global economy, hit the subscribe button and drop a like on this video.